Welcome and thank you all for joining us for this episode of the Crexi Podcast, an insider's look at all things commercial real estate. I'm your host, Yannis Papadakis, Business Development Manager at Crexi's auction platform, and we are thrilled to sit down with Ehud Gersten, Managing Partner at Perch Wealth, for a round two conversation about a Delaware Statutory Trusts and much more. With that, let's dive in. Ehud, how have you been?
I've been well. Thank you. How are you?
I'm doing well. Now, we spoke, has it been a year since our last podcast?
I believe so.
Okay. How have things changed in the last year since we talked? I mean, there's been a lot of stuff happening in the market. Let's just get a brief overview.
Yeah, where do I even begin? Many things have changed. There's definitely been a slowdown overall in the market in terms of transactions. We're still busy, but there's definitely been a slowdown compared to last year in terms of 1031 exchanges, especially with interest rates going up and a lot of changes we can dig deeper into, but it's still an exciting time to be in investment real estate.
Ehud, let's start with kind of reviewing, what's new in the world of DSTs. And for those in our audience that, may not be familiar with our first conversation, let's quickly recap briefly, what is a Delaware Statutory Trust?
Sure. So a Delaware Statutory Trust is essentially exactly what it sounds like. It's a statutory trust or a business trust that's set up under Delaware law. And it's not only for real estate, but it's predominantly used by real estate investors. And it essentially allows investors in that trust, where the trust owns the property and the investors own a pro rata share of the trust. So it allows for a lot of different benefits for investors. First of all, being limited liability. They're not on the hook for any debt or obligations of the trust. And yet they still get the benefits of the flow through of any income that's being generated or credits or distributions. So it's essentially a trust that allows people to invest while keeping their limited liability at an absolute minimum. The most that a person can lose is whatever they've invested in the trust. And it's a great legal structure for owning real estate.
And as I understand it, DSTs are relatively new. How would they fit into a prospective investor's portfolio?
Sure. So DSTs have been around actually since the 80s, but it was really in the late 90s that a lot of the sponsors that we call sponsors, the companies that put these DST together, that they started offering these to the wider public. But it wasn't until 2004, so 20 years ago, that the IRS actually came out and said that DSTs qualify as a 1031 exchange, like-kind exchange. So you could invest today, and you have been able to for the last 20 years, you're able to invest in a Delaware Statutory Trust as part of your 1031 exchange, thereby deferring your taxes and all the other benefits and advantages of DSTs that we can kind of dive into.
I'm curious. Let's say, after somebody does a 1031 exchange into a DST, do their heirs still get a stepped up basis upon passing the property on?
Yes, absolutely. And that's a good point. So one of the things, and this comes up a lot actually with our clients, is that they ask us, they think that DSTs are different somehow in terms of traditional real estate, where you go out and you buy the asset directly by yourself. We're still in the world of 1031 exchanges. We're still in the world of real estate. So everything that affects the rules of 1031 exchanges, it also applies to DSTs. So all the tax laws apply the exact same way. And the easiest way to explain it, at least the way I've commonly explained it to folks, is think of a 1031 exchange as getting from point A to point B, right? And you can get from point A to point B. You can take a car, you can drive, you can ride your bicycle. And the DST is one way to get from point A to point B. You're still doing a 1031 exchange and all the rules are the same, but you're just doing it a different way. And that other way that a lot of people are most familiar with is going out and buying the asset directly.
Tell me, does a investor that exchanges into a DST, versus traditional real estate, would they still have the possibility to see appreciation by being part of a DST?
Yes, absolutely. So that's one of the great advantages of DSTs is that if you invest in a DST and the typical hold time in a DST, investors should typically understand they're going to be in this investment anywhere from 5 to 10 years. If at the end of that 5 or 10 years, when that asset sells and it's appreciated in value, investors get 100% of that appreciation to whatever their pro rata share is, right? So if I've invested $1 million in that DST, and at the end of 5 years, that asset has increased in value by 10%, then I'm going to get my million back, the principal, plus another $100,000.
Excellent. Well, I mean, it sounds like an option that, may be a really good fit for somebody that's looking to maybe take less of a managerial role when it comes to completing their exchange. If they're looking to, lower their landlord responsibilities. We've covered the basics, but let's dig a little bit deeper into the world of DSTs on a more advanced level. Since DSTs were relatively new to most people as an investment vehicle when we last spoke, even though they've been around for 40 years now. Based on our prep call, does it sound like their role has evolved quite a bit in involving the future of real estate investing? Are you seeing kind of a larger adoption of buyers exchanging into DSTs, and what do you think is fueling it?
Absolutely. And I believe what's fueling it is demographics. Essentially, DSTs are really designed for an investor that wants to be hands off, completely passive. Many of our investors are baby boomers that, they've retired and they're tired of dealing with tenants and getting calls in the middle of the night. And if they sell their property and they end up doing a traditional 1031 and going out and buying another property, they're still potentially going to have to deal with those phone calls and management responsibilities. And so a lot of people, what they really like is the passive nature of DSTs. And as a consequence of that, because we've got a growing population of baby boomers that are retiring, and it's been called the greatest wealth transfer in history, actually, with all these people that are retiring and they don't want to manage their assets anymore, their real estate assets. DSTs are popular, and I think they're only going to grow in popularity because of the fact that they're passive. And also from a risk mitigation standpoint, if you're in your 50s, even 60s, 70s, 80s, you don't necessarily want to be taking too much risk in your investments, not just in real estate, but any investments. And so one of the benefits of DSTs is that you can help mitigate that risk by diversifying it over multiple DSTs. And you can't really do that by buying one asset on a direct purchase with a 1031 exchange. So like most things economically, it's driven by demographics, and we have an older and aging population that they just don't want to be involved in management.
And I know we touched on this when we last spoke, but can you go over some of the benefits of a DST if, let's say, you have to replace some debt as part of your 1031 requirement?
Absolutely. And I'm glad you raised that, because debt nowadays especially is a bigger issue than it was a year ago, for example, than when we last spoke.
Right.
So with interest rates going up, one of the things that we're seeing is a lot of people that they don't necessarily want to sell the asset that they currently own, but maybe a loan is coming due and they're going to have to refinance, and the rate they're going to have to refinance at is going to be much higher than what they originally financed it at when they originally purchased the property. And so, the first issue is higher interest rates, right? So you're getting out of a property. If you sell your property and you're going and buying your own property directly and you need debt, you're going to pay more. Very likely you're going to pay a lot more in interest than you were on the downleg property that you just sold. But another issue is that's assuming you can even get a loan. Many banks, commercial banks today, have tightened their lending standards because of the concern regarding commercial real estate, especially around certain asset classes, as we know, like office space. So DSTs have become a really incredible tool, because when you invest in a DST, if you need to replace the debt from the property that you just sold, many of the DSTs that we have already have the debt on them already. So the investor gets the benefit of the debt that's already on the property, but they're not responsible for that debt. It's limited liability. It's non-recourse to them, which means they're not on the hook for that debt. So they get the benefit of that debt, but they're not responsible for that debt. So I think just the fact that they can take care of the debt component if they need to in a very easy way compared to traditional purchase, and also the fact that they're not on the hook for that debt.
Ehud, if somebody exchanges into a DST and let's say a couple of years later, they see an opportunity they really want to pursue, can they exchange back out of the DST and into the traditional market?
Yes, absolutely. So let me just qualify that statement. The answer is yes. So if you've invested in a DST and that asset sells, let's say in year 5, once that asset sells, you have the ability to do a 1031 exchange by going into another DST if you wanted to, or you could take that money that you got from the sale and do a traditional 1031, like buying a property direct, or you can cash out. So you have the same options as you did before you even went into the DST. However, if you want to sell your interest before that asset sells, there's no secondary market. So you really it's legal to sell your interest, but you have to find a ready and willing buyer that's willing to buy your interest in that DST. But if you're comfortable with the fact that you're investing in a property, you're potentially going to be in there, let's say from 5 to 7 years, then you just wait till that asset sells, and then you can do a 1031 exchange into anything that you'd like to. That's valid, right?
Yeah. Is that something that Perch Wealth can help with? If, let's say, somebody wants to exit the DST, before that asset sells, is that something that you help organize, finding, a replacement buyer to take over that position?
Yes, the answer is yes. We definitely help investors do that. But again, I want to kind of set expectations, because the reality is that if you invested in a DST, typically the process is if you want to sell your interest, and most of the time this comes up if people need cash, emergency cash. It actually rarely comes up that somebody wants to sell their interest. But if a client came to us and said, I invested in this DST with you and I need to sell, or I want to sell my interest, then typically what we will do is, number one, we would reach out to the sponsor, the trustee that's actually managing this asset, the asset manager on behalf of the investors, and see if they're interested in purchasing that interest, or they have one of their existing clients that's interested. And then we will also reach out to our existing database to see if anyone else is interested. We've done it a couple of times, we've done it a few times, but it's not something that comes up a lot. But again, just to set expectations, there's no secondary market for this. So it's not as though you can just, like you're buying a stock and selling a stock. It's real estate, and you have to find someone that wants to buy your interest, and then there's a negotiation process. So yes, we've helped people, and yes, we're happy to help people if that's something that comes up.
And how can brokers advise their clients on DSTs and implement their advantages into their businesses, right? Like what tools would a broker really need to familiarize themselves with to, help navigate their clients through a DST, especially when dealing with a 1031 exchange?
Yeah, absolutely. First of all, I think just understanding the general characteristics of DSTs, and understanding that DSTs offer a solution to their clients that are doing a 1031 or considering doing a 1031. So I would break it down into different timelines, right? So sometimes you've got real estate agents or real estate brokers that, they're farming an area. They want to get someone to list the property with them. Well, many times an owner doesn't necessarily want to sell because they don't want to deal with the hassles of a 1031 exchange, especially if they've done it before. And traditional 1031 exchanges can be a pretty significant headache because you have very limited timelines and it can be very stressful. So for an agent or a broker that's trying to get that listing, understanding how DSTs can help that client, they can approach that prospective client and say, listen, if you allow me to sell your property, if you list the property with me, I have a solution that allows you to do a 1031 exchange without the regular headaches that you would otherwise, and the stress that you would otherwise have to deal with. So that's before the asset's even sold. Once the asset sells, many times we have brokers or agents that come to us and they're very stressed. Why? Because their clients are stressed. So if their client's stressed, they're typically stressed as well, because let's say they're on day 40 or 43 or even day 45 and they tell us, look, I've got a client, he sold the property for $10 million and we thought we had this other property or properties locked in, right? We've identified them, but it looks like we're not going to be able to close. And the client is very stressed because they're worried they're going to have to pay a lot of money in capital gains and depreciation recapture tax and all that. So if they understand that DSTs are a solution for their client where they can help their client, and I've had one realtor that said to me, you guys saved the day, because the realtor had sort of promised the seller, their client, that they would have no problem finding a replacement property, and they were having trouble finding a replacement property. So when they found out about DSTs, it was sort of a simple solution for their client where they didn't have to worry about the potential taxes.
I mean, have you seen a lot of those day 45 scenarios cross your desk? And is a DST something you have to identify ahead of time? Or, let's say you're in that, emergency goal line situation where all three of your identified up legs are no longer viable for some reason. Is that something you can immediately get into?
The answer is yes. I have seen too many people in their 45th day contacting us. It explains the gray hairs that I have. But typically most folks, they come to us earlier on, but we can help them, because one of the great things about DSTs is it's sort of like going to a restaurant. There's always food on the menu. There may not be everything available, but there's always availability of some investments. Now, obviously, those investments, every investor is going to be different, right? Different risk and different interests and different asset classes they like. So, but generally speaking, there's always going to be DSTs available. And if someone comes to us on day 45, then we can help them. We can help them quickly identify a property or properties that they would like to invest in or potentially invest in. And it gives them sort of like an insurance policy. And one of the things that I also recommend for realtors and brokers to understand is that even if their client is more inclined to buy something directly, let's say there's a property that they love and they've identified it, it's worthwhile having a DST or a few DSTs as backup options, sort of like an insurance policy in case that particular purchase falls through for whatever reason. So you can use DSTs in multiple ways. And, we've had clients that have gone into DSTs, they've closed on their property, and we can get them into DSTs and done with their entire exchange in typically 5 business days.
Wow. Tremendous. I mean, it sounds like any broker worth their salt should really familiarize themselves with this in, not only to present it to their clients, but in the event 1031 goes sideways, you do have a magic bullet, so to speak, to, help get the train back on the tracks.
Absolutely. Yeah, it's certainly something that brokers and agents should understand. They might not use it, but it's another arrow in their quiver where they can come back and say, okay, they can help their client, because sometimes clients get in a situation where, you are on day 40 or 43 and you find out, what, the property I thought I was going to buy, I'm not going to be able to buy because I'm not getting the financing I need from the bank. Or you find out there's something wrong with the property, or the seller decides to to renegotiate what you thought was a closed transaction. So it's the DSTs allow you to sort of like secure a position, right? In a DST and close. Amazing.
Well, Ehud, let's take a step back a little bit and take a look at kind of a broader macroeconomic standpoint. How are trends like higher interest rates, inflation, an aging population, affecting the popularity of DSTs? And you mentioned on our prep call that, a demographically aging population is growing out of more active property management. How do DSTs serve as a tool for private owners, seeking to transition into more passive ownership? And I know you've already touched on this a little bit, but can you share maybe some examples from people that you've worked with, what they sold and kind of what their feedback has been since going into a DST?
Yeah, absolutely. I mean, the feedback is, once I tell people, once you've gone into a DST, it's very difficult to change course, not from a practical standpoint, because people don't want to. I mean, they get used to the passive nature of DSTs. They get used to the not having to manage the property. They're getting distributions every month, typically, and they like it, and they don't have to actively manage the property. They know they have some of the largest real estate companies in the country managing it on their behalf. And it doesn't mean that there's never any issues. I mean, we're still in the world of real estate. We're still, subject to the overall economy, but you can help mitigate that risk by choosing certain asset classes and areas that you want to invest in, and investments with sponsors that have a proven track record that allow you to mitigate that risk. And our clients, that we've helped are happy with these investments because of that, right? It's passive. They don't have to do anything, and they can get into the kind of real estate that most of them, the vast majority of most people, cannot get into. I mean, you can get, you've got a $200,000 exchange, right? You sold your condo in I don't know, Arkansas for $200,000, and you don't have too many options of what you can buy nowadays, because you bought it maybe for, God knows how long ago. Nowadays, you don't have too many options of what you can go into. Well, with the DST, the minimum is $100,000. So you can take that $200,000 and you could be a part owner of a $50 or $100 million asset. It's incredible.
That is. I mean, it really does seem like it gives more investors an opportunity to reach into maybe markets and product types and, the higher quality and class A type real estate that they may otherwise, not be able to, get anywhere close to based on, what they sold and, their 1031 exchange requirements, unless they were to do a DST.
Yeah, absolutely. And sort of, more niche areas, for example, like nowadays we're seeing a dramatic rise in consumption of computer chips, right? So I'll give you an example. Right. We have a DST right now that the manufacturer is a semiconductor company. They make computer chips. It's actually based in California. We have data centers, right? You can invest in a data center. There's senior housing. So we were talking about an aging population before. Well, if you have an aging population, not just they're selling their assets, but typically that aging population, many of them need care, and there's more of them that need care. So you have a massive demand for senior housing. So they can get into senior housing. When it comes to things like multifamily, in certain areas of the country, construction costs have gone up, supply is limited, so fewer people can afford to buy a home. So especially younger people. So the investors can invest in multifamily in areas where there's a lot of demand. There's build for rent, which is sort of the new kid on the block, so to speak. It's where people want to live. They want to live in a house, but they can't afford to buy a house. So you've got these new DSTs that have come out in the last year or two called BFRs, build for rent, where the tenants, they're living in a house. It's not an apartment, and investors can invest in that. And there's a lot of demand for that as well. I'm just giving you the tip of the iceberg, so to speak. But
yeah. And can you go into a little bit about how institutional owners can take advantage of DSTs for their particular investment goals?
Yeah, absolutely. So, I mean, if we're talking about pension funds or endowments, institutional investors typically have enough capital to go out and buy these assets by themselves, right? If you're a pension fund, you can go out and buy your own large asset. But many of them, they have the ability to diversify, like we're talking about DSTs. So instead of buying, it's the same thing applies to institutional investors. Why would you go out and buy $100 million property and that's your one property that you're transferring into? Or, you can still go into that $100 million property, and you can also go into maybe 2 or 3 other properties that are worth 40, 50, $60 million. So it's the same rules apply in terms of the ability to diversify, the tax mitigation for 1031 exchanges, and especially for institutions, right? Because if you're an institution that you already have an existing real estate portfolio, where you want to keep it as diversified as possible. And if you're an institution that, for example, is heavily allocated in stocks and bonds, then you want to invest in alternatives like real estate, and especially real estate that gives you the tax benefits, or your investors the tax benefits.
Now, Ehud, we talked a little bit when we first started that the landscape has changed even since last year. Can we talk a little bit about top performing asset classes that are trading today, and then looking ahead, how do you see those trends moving?
Yeah, I think first of all, multifamily, again, everything is dependent on location, right? We always talk about location in real estate, and DSTs are no different. But speaking generally, multifamily is still something that I think is going to drive a lot of demand, because because of interest rates going up, fewer people can afford to buy a home. And so they're going to end up being renters. So multifamily is still a strong one. We talked about senior housing. I think there's a growing population of people who are older and needing that kind of care or want to live in a senior housing community. So I think that one is a good one. We were talking about, the advancement of technology. So semiconductor plants, like I mentioned earlier. We have DSTs that are life sciences. So essentially pharmaceutical companies or companies that support pharmaceutical companies. Industrial, especially after COVID, you have a lot more efforts on bringing onshoring, where there's a lot more production of things, actually making things here in the United States. So industrial has become a really hot asset class because there's just so much more demand for industrial. All of those, industrial, semiconductors, life sciences, multifamily, senior housing. We even have oil and gas as one of the options for people to invest in. And that one is interesting because many people don't know this, but mineral rights qualify for 1031 exchange purposes. So, you can do a 1031 exchange into a mineral right ownership position. And, one of the reasons that I personally like oil and gas as an investment is that it helps mitigate and hedge risk in potentially other investments. Because traditionally, it's a commodity. So traditionally, inflation goes up, which it has been, especially today. The report came out, wholesale consumer index, whatever, it came out higher than expected. So inflation is going up. And typically commodities will go up with inflation. So you have a situation where people can invest in these types of asset classes. And again, the idea behind all of this is to preserve principal, mitigate risk as much as possible. Especially if you're in your 60s, 70s, or 80s, it's typically not a time where you want to take big risks, right? You've worked, yeah.
I was just going to ask, can we look at the flip side of that coin? Are there any assets that, people are starting to shy away from more than they were last year?
Yeah, I think compared to this time last year, first of all, office was already starting to take a bit of a beating last year, but I think it's only accelerated with more people working at home and the landscape of workers changing, and not just in the United States, but really all over the world. So office space is hurting. I think depending on where you are, even self-storage, there's some areas that they've overbuilt self-storage, and compared to, for example, multifamily, it's much cheaper to build a self-storage facility than it is, a multifamily complex. So you're seeing more operators building self-storage. So you might have a glut of inventory of that in certain areas. But I think the one that stands out the most is really office. And even in the asset classes that I mentioned, actually, You can, even in multifamily, I mean, you could invest in multifamily and there's a lot of competition in that area. So one of the things that we do at Perch Wealth is when we are looking at an investment that's going to be presented to our clients, before it's presented to our clients, we do our own due diligence and we look at the different things that might affect that particular investment. There's no guarantee that investment will work, but we try to mitigate it by doing as much research and as much due diligence that we can to figure out what are the projections for this. We don't take the sponsor at their word. So if we know that there's a multifamily, for example, in Dallas, Texas, and it looks amazing on paper, right? It looks like a beautiful complex, a lot of demand, but then we find out that across the street they're building a brand new multifamily complex. That's going to put downward pressure on the rents that they can charge. So those sorts of things we're constantly looking at.
Can you talk a little bit about what current economic challenges are facing DSTs right now? I mean, we mentioned rising interest rates. What about challenges of finding proper leverage? Are DSTs as affected by kind of where lenders are tightening up across the markets?
Very much so. And I'll give you an example. So compared to this time last year when we last spoke, interest rates, like I said, we're still in the world of real estate. So the lenders, if someone's going out and getting a loan today, they're probably paying more than what they paid a year ago. And that holds true for the DST sponsors that are buying these assets. So what you're seeing now compared to last year, for example, is you're seeing more DSTs that are debt-free, that have no leverage whatsoever. And the ones that do have leverage, they typically are much lower on average than they used to be. So for example, prior to maybe interest rates going up, a lot of DSTs you would find typically were around, let's say, 45 to 65% loan to value or leverage. Now it's not common to find anything north of 45% because the cost of money is much higher now.
Right.
We do still have DSTs that have higher LTVs, but they're fewer than there were in the past because of the cost of capital. However, having said that, the cost of capital for these DST sponsors is typically less than most people will pay, right? The rates they can get because they're bigger, right? They have established relationships with lenders. They can typically get better terms than the average person can get on a loan. But it doesn't diminish the fact that they still have to get a loan sometimes. So it's harder to find DSTs with leverage.
Got it. Moving on to our next topic, what information would you give fellow brokers or CRE professionals exploring DSTs?
Well, first of all, educate yourself like anything. I mean, what sets you apart as in anything in life, but specifically for an agent or a broker, is understand your craft, understand what you need to know to help your clients. Because if you help your clients, if you become a resource for them, a resource of knowledge, they will be happy and they will refer more business to you. And that's true generally. As it relates to DSTs, I think it's just a matter of really studying up on what they are. So for example, like this podcast that we're doing, Ben and I, my partner, we spent a lot of time educating folks about DSTs. We teach at realtor associations. We've done presentations to CPAs even and attorneys, talking to them about what are the benefits and limitations of DSTs and how they relate to 1031 exchanges. So, if you want to be a better agent, if you want to get more business, understand all your clients' options and present it to them.
And then same question, but posed towards the investors that are looking to get into DSTs.
Same thing, right? This is, you've worked hard for your money. You've bought an asset or you've inherited an asset and someone else worked very hard for that. Understand how DSTs can help you. Understand that you're not limited by traditional 1031 exchange requirements where you sell your property and you go out and you have to buy one property or at the most maybe two properties. Understand that DSTs give you another option, right? And I love options, right? Options are good because they give you the ability to diversify your investments, the ability to mitigate your risk. So just understanding what your options are when it comes to 1031 exchanges, even before you sell your asset, And it's not for everyone, right? Some people don't like the idea that they're giving up control of the management. But if you're comfortable with that and you like the asset classes and you like the passive nature of it and diversification, I think it becomes a really viable solution.
Excellent. Well, Ehud, thank you so much for joining us. It's always great to hear your insights and catch up with you on what's happening in the market and in the world of DSTs, especially, in such timely and important topics and when the market really is shifting. And I think options are definitely what investors need, right? And to educate the brokers too, so that they know what options they can pass on to their clients to best serve their goals. So I know you're very busy, so thank you for joining us.
Oh, Yannis, it's my pleasure. And if anyone wants further information, they can go to our website, which is perchwealth.com, and our handle on Instagram and LinkedIn and Facebook. It's all perchwealth.com. But if they go to our website, especially, we have a tremendous amount of. We've written many articles, educational videos, with the idea of really teaching investors and real estate agents and CPAs and attorneys about something that, even though it's been around officially for 1031s for 20 years, literally 20 years, it's still very much misunderstood and or not known about at all. So having these conversations with you, with Crexi, we love doing it, and thank you.
Well, thank you again, and thanks to everyone who tuned in today. If you enjoyed this episode, do not miss the next one. Visit go.crexi.com/podcast and sign up to get the next episode delivered straight to your inbox. Of course, you can also subscribe to the Crexi Podcast on your favorite podcast app, or check out our YouTube channel for videos of each recording. Thank you, take care, and we'll see you next time.